Hey guys, welcome to DevTech Finance. In this video, we would be learning about the term called bonus issue. So let's start. A bonus issue of shares is made to the existing shareholders of a company without any consideration from them. The entitlement to the bonus shares depends upon the existing shareholding of the investor. As shareholders, the shareholders are holding ownership in a particular company. So, what happens is that when company is running into profits, the investor expects some kind of benefits to them as a ownership in the company. So, many a times these companies issue bonus shares. Now, other than giving monetary consideration, they provide entitlement to extra shares of the company, giving extra ownership in the company. And thus, this issue is generally done in ratio. So, for example, if a bonus issue is in the ratio of 1 is to 3, it means that the shareholder who is having 3 shares will be given one extra bonus share. So, this is how generally the bonus issue of shares is done in ratios. The company makes the bonus issue out of its free reserves built from genuine profits. So it is instructed that the company has to make bonus issue out of its profit which it has earned over the financial year and not out of the reserves. So the companies held reserves for meeting several uncertain events as well as several other obligations. But when it comes to issuing of bonus shares, that cannot be made out of reserves. That has to be made out of the profit earned by the company. So this also builds a trust in the investors that the company in which they have invested that is growing in profit, and thus they are able to issue bonus shares. So it also indicates the better position of the company, the growth in the company's profit. A company cannot make a bonus issue if it has defaulted on payment of interest or principal on any debt securities issued or any fixed deposit raised. So, a company can raise financing, can raise money from various sources. So, as we see, one source is by issuing shares to the public, other source could be by issuing debt securities. So, debt securities like bond, fixed maturity papers, commercial papers, or certificate of deposits, all these are debt securities, and by issuing that the company can also raise financing. But the difference is that in equity shareholding there is no fixed obligation to pay to the interest to the investors at a certain period of time. But when we talk about debt securities like bonds, the company is obliged to pay a fixed amount of interest rate over a set tenure of time as per the particular financial asset. So it says that a company, if it has defaulted on the payment to that debt securities, it cannot issue bonus share. So first priority should be of paying to the debt investors. So paying them their fixed amount and not defaulting on their payments. After that, only the company can take the decision of issuing bonus shares to equity investors. A bonus issue once announced cannot be withdrawn. The record date for the bonus issue will be announced, and all the shareholders, as on the record date, will be entitled to receive the bonus. So, as it is clear with the line that once the company has announced that it is going to issue the bonus on a particular date, it cannot withdraw its announcement because it's the declaration made in the public, so it cannot withdraw that declaration. And after that, the company has to provide that bonus shares to all its shareholders on the date on the recorded date for which it announced, and thus the shareholders will be entitled to receive that bonus in their shareholding pattern. So thank you for watching. Do like and share my videos. Subscribe to my channel DevTech Finance. Thank you all.